Well, good morning, everyone. Good morning, everyone. I know we have some people who are starting to roll in, but we're up to over 100 attendees already, and we had over 400 register here today for our North County Economic Summit. And we're really looking forward today to bringing you, I hope, a really informative summit for North County and thinking about how we recover and what sort of the future lies in a post-COVID world. I want to start by thanking our sponsors for today's event. They make the work that we do at the San Diego North EDC possible. I want to thank Wells Fargo, our presenting sponsor, Cal State San Marcos, Palomar College, Tri-City Medical, San Diego Gas and Electric, CW Driver, and Miracosta College as our premier sponsors. And then Olivenhain Municipal Water District, Voight Real Estate Services, Harrah's Resort of Southern California, the Toll Roads of Orange County, San Diego County Water Authority, San Diego County Food Bank, Integral Communities, Res Care Workforce Solutions, North City, Right On Communications, the City of Carlsbad, Mental Health Systems, BW Research, AMR, North County Transit District, and EDCO for their support in making this possible. We would be doing this at Cal State San Marcos, and they would all have breakfast tables, but again, with COVID. People reminded me that I just started talking. So this is Eric Bruvald, the CEO of the San Diego North EDC. And technical guru this morning, or lack thereof. I want to thank our public sector partners who were involved with this and helped us put on the summit. That is the County of San Diego, the cities of Escondido, San Marcos, Vista, Oceanside, Carlsbad, Poway, and Encinitas, and are over 70 private sector investors who believe in a competitive North County. I want to thank All Maven Communications. When we moved to online, we wanted to ensure that virtual attendees had a great experience and one on par with the kind of events we try and put on. They've executed this webinar and I think done a great job in standing up a registration process. And for those interested in branding, PR, web design, and online meetings, they are a local North County company that we suggest is worth checking out. And then finally, and I think most excitedly, Josh Williams in his presentation at the end is going to have 5 things or 5 recommended courses of action to take for North County moving forward in a post-COVID world for how we can recover faster and get our economy back moving again. The North County EDC is going to convene working groups and dialogues on each of these over the next 60 days. And if you're interested in participating and contributing, you can sign up at the website that you registered at www.nceconomicsummit.org or on our website at www.sdnedc.org. And we'll be talking about that as we go along through the event. For the agenda today, Mark Vitner from Wells Fargo Securities is going to kick us off and give us a national and state outlook for how things are proceeding. Then Josh Williams from BW Research will give a North County specific overview of the impacts that COVID-19 is having on North County and how we're doing as a region in terms of our competitive position. And then to kick off our questions and answers series, our section, we're pleased to be joined today from Miguel DeJesus from the College of Business Administration at Cal State San Marcos, and Ray Major from the San Diego Association of Governments. And I'll be giving fuller introductions to them when we get to those sections. But let me start by by introducing Mark Vitner from Wells Fargo Security. Mark is the managing director and senior economist at Wells Fargo Security LLC, where he's responsible for tracking U.S. and regional economic trends. He's based in Charlotte, and he also writes for the company's monthly economic outlook report and the weekly economic and financial commentary, which provides regular updates on the housing market, commercial real estate, and other matters. His writing's been featured in the New York Times, the Wall Street Journal, Bloomberg, and many other publications. He has a BBA in economics from the University of Georgia and an MBA from the University of North Florida. He's extensively involved with the National Association of Business Economics, and we're excited. Mark has been with us a number of years presenting at the North County Summit, and so we're excited to have Mark Vitner join us today. So with Mark, you can go ahead and share your screen and walk us through what you're seeing at the national and the state level.
All right, let me see if I can pull that up fairly quickly. Too many things open here. There we go. And what I'm going to do is I'm going to go through this fairly quickly and give a kind of our overview of where we are in this in dealing with COVID and where we see the recovery. I don't want to rehash too much of what we've been through, but the progression of this recession is that in January and February, we started off the year in pretty good shape. We had fairly strong growth, although we were seeing some parts of the country were slowing a little bit. In California, job growth had moderated somewhat in January and February. And one of the trends that we were seeing was a bit of a different kind of affordability migration, where people were moving away from higher cost areas of the country to lower cost areas of the country. But we were still growing solidly in January and February. And in late February, I mean, really it was February 29th, that's when we got word of the first person dying from COVID, at least that we knew about, on February 29th. And, within 2 weeks, concerns had ratcheted up quite a bit, and we began to see shutdowns across the country expand. And really the second half of March, everything shut down completely. And that shutdown wiped out all of the earlier economic growth. And we wound up with a modest decline. I should say modest, a fairly significant decline. Is modest in comparison to what we're going to see in the spring. But real GDP declined at a 4.8% annual rate. In April, most of the economy was shut down. And we're looking for second quarter GDP to decline somewhere in our forecast, which there's a forecast table in this presentation. We've got a decline around 25%. But judging from the latest employment data and looking at the hours worked in the economy, I would say that decline is probably going to be somewhere in the neighborhood of 30 to 35%. The unemployment rate went up to 15% in April. The Labor Department said, hey, it would have been worse if not for so many people chopping out of the workforce. We would have, some people mischaracterized their job loss and said, no, I still have my job. I'm just not there today. And they said the unemployment rate would be closer to 20%. We're expecting to go up more in the month of May. So it'd be 25% maybe at its peak. We haven't seen anything like that since the Great Depression. And so we get a lot of questions. Is this another Great Depression? It's not. In the Great Depression, the overwhelming majority of job losses were permanent. In the current environment, the overwhelming majority of job losses are temporary. 78% of job losses were identified as temporary. The best example I can give for that is Starbucks. So if you worked at Starbucks and the Starbucks closed over the last 6 weeks and you couldn't go to work, you would have been classified as unemployed. You would have been classified as having lost your job in the non-farm employment numbers. But you still had your job at Starbucks. And when they reopened, they're going to call you back and ask you if you're going to come back to work, and if you can come back to work. And that's what a temporary job loss is. And so 78% of the job losses were deemed temporary. I'm concerned, though, that not all of those are going to prove to be temporary, because not every restaurant and bar our business that closed down is going to reopen. And I said restaurants and bars and then businesses followed by that, because about 46% of the jobs that were lost so far in this recession have been in the leisure and hospitality sector. We've also seen a lot of jobs in retailing, a lot of jobs in healthcare. And just leisure and hospitality and retailing is over 50% of all the job losses. So certainly there are a lot of temporary job losses in there. But I think a lot of restaurant owners are going to look at the social distancing guidelines. We're not likely to have a vaccine. The news has been much better recently, but we're not likely to have a vaccine that's distributed nationwide and worldwide until at least, if everything goes right, I sure hope it does, the spring of next year. So, I mean, so like a lot of restaurant owners are going to look at their business and say, gosh, I don't know if I can make it in that kind of environment. And so we're going to see that a number of businesses are going to choose not to reopen. But looking at the balance of economic data, looking at the mobility data from folks like Apple and Google, the data from the TSA on the number of people going through checkpoints, the number of restaurants that have reopened around the country, we are in the early stages of an economic recovery. And that comes as a surprise to a lot of folks, but this recession is likely to have proved at least the declining part of economic output is going to have proved fairly short-lived. The decline in economic activity began in March, in the middle of March, and it ended in the middle of May. And the economy is now growing, and I think that we'll see some pretty solid numbers for the month of June, which will be reported in the month of July. But the really strong numbers will be July, August, September, when we should see economic activity rebound at about a 10% annual rate and see the unemployment rate begin to come back down again. That's not going to prove to be a V-shaped recovery, but while it's going on, I think a lot of people are going to say, well, it looks like a V to me. I mean, the economy's coming roaring back, strongest GDP numbers that we've seen in the nation's history. That's all true, but it happens to follow a 30% decline. So if we drop 30% in the second quarter and rebound at a 10% rate in the third quarter, that's not going to get us back to where we started from. After that initial rebound, we think that growth will be much more modest. Now, I don't want to give folks the wrong impression here. So I'm going to walk you through a little bit of an analogy. If you are walking along and you are on your iPhone and somebody just said something that annoyed the heck out of you and you're typing out a response on them and you're not paying attention to where you're walking and you fall right into a hole. When you hit the bottom of the hole, that's when the recession ends. So you think about the economy in that sense. It falls into a hole. The recession ends when it stops falling. Now, just like you're on your smartphone and you fell in that hole, you're like going, man, what are you talking about? The recession's over. I'm in a hole. Well, I mean, most people would think that the recession wasn't over until they got out of the hole. Where we're going to be in the third quarter is that we're going to be beginning to climb out of the hole. I don't think that we will be totally out of the hole until probably the late end of 2021 or the early part of 2022. It really depends on what happens with the virus. And, I know that you've heard that from a lot more influential voices from me, because I'm not a scientist and I'm not a physician, but I don't even play one. But we do have a pretty good biotech research team, and they laid out a couple of things that needed to happen in order for the economy to recover, and how they develop will largely determine how strong the economic recovery would be. First off, we need to see that this virus behaves like other viruses, in that warm and more humid weather tends to slow its spread. And there's been some mixed evidence on that around the world. And Singapore's had kind of a second wave, although they haven't had a whole lot of cases, and that second wave came from workers that came from other countries. But But so far, case growth does appear to be slowing in the U.S., and it's encouraging on that front. We also need to see the continued development of therapeutics. Remdesivir was the first one that was approved, and we need to see some others. There are 3 others that are in the pipeline that look like they will be approved. I can't tell you when, because it's just kind of a convoluted process, but it looks to me like they would be approved by midsummer. And that we would also have to see progress on a vaccine. And on that front, a number of manufacturers, a number of drug companies have reported pretty good progress on making a vaccine. Scott Godley was on this morning and said that he thought that it was highly likely that we would have a workable vaccine by the end of this year, but not in enough quantity that to immunize the country, much less the world. I think he said it the exact opposite, but I think he meant to say it that way. But that it would be available for first responders, healthcare workers, and maybe to address some sort of an outbreak. And there's still a tinge of optimism in that forecast, but I do think it's, from everything that I've read, it certainly seems possible. And that a mass-produced vaccine might be available from a number of folks by early next year. If that happens, it's not like, okay, we're back. Even though the stock market seems to be acting that way, it's not going to happen that quick. The stock market does tend to pull things forward. But my sense is that if everything progressed on the most optimistic timetable that we have, that maybe we get back to where we were. The economy gets back to where it was by the end of 2021. If we slip a little bit, I think it's going to be 2022. But we still got a long way back. And in the meantime, the Fed's going to keep interest rates low. We don't have them raising interest rates at all over the next couple of years. In fact, when I'm pushed as to when people want to nail me down as to when do you think the Fed's going to raise rates, I say March of 2023. And I don't even know if they have a meeting in March of 2023 because they haven't published their schedule, but they usually have one around that. So maybe we'll say February, March 2023, somewhere out there, but it's a long way off. California's been hit very hard by this. Its ties to China, its ties to Asia, its ties to international trade are all much greater than most other parts of the country. Texas also has some pretty strong ties to international trade, although it's much more tied to the energy sector. Tourism has certainly taken a huge hit, which is one of the reasons that the strong ties to tourism, international trade, are one reason why Southern California has seen so many more job losses than Northern California has. The tech sector is clearly struggling a little bit. Startup activity has slowed. We've seen some layoffs at startups. We've seen some layoffs at larger tech companies too. But the job loss in Southern California really dwarfed what we've seen in Northern California. We do expect conditions to improve. A big question mark that I have in the California outlook, though, is some of the frustration. And one of the things that issues that California policymakers have to deal with is that you've got so much of your economy in greater Los Angeles and greater San Francisco, which have been 2 hotspots for the virus. And so that tends to set the tone for the policy response, whereas much of the rest of the state is in a different place in regard to the virus. So I think there's a lot of frustration there. We have seen anecdotal evidence of a little bit of a push by individuals. We don't have information from businesses, but from individuals seeking information to relocate outside of the state. And so we're looking to find a way to quantify that, just like we did some of the other things. You don't want to mess with it. That should make it a little bit bigger. In terms of new cases of COVID in the United States, the curve's flattened. It's actually going down, even as more and more states are reopening. As many of you have heard me before know, I cover all of Wells Fargo's markets. I actually grew up in Atlanta, Georgia. Georgia was one of the states kind of got blasted because the governor came out there and said, hey, man, we're just ripping off the Band-Aid. We're going to reopen everything at the same time, or allow. And really what the message that did get out there, they allowed everything to reopen. Everything did not reopen. their reopening is not is really roughly on par with what we're seeing in North Carolina, which is where I physically sit, which has been probably the slowest state to reopen in the South. So both states have seen a continued decline in new case growth. And the numbers look a whole lot better if you separate out nursing homes and meat packing plants, which is a problem area in Georgia, which has got a lot of poultry processing. But even with that, their numbers have been coming down. Most states have been coming down. And if we're going to see a second wave, I don't think it's going to be over the summer. I think it would be more likely that it would be in the winter after Thanksgiving, late fall and early winter is probably the greater risk there. In terms of where the U.S. is, this chart doesn't do a perfect job of explaining this, but Europe began to see cases pick up about 2 weeks before the United States did. The United States is the black line on this chart, and so their numbers look a little bit better. In some countries, in an overall sense, they look fairly close to the U.S., but they've been tracking the same lines. And I think that we'll be pretty much, we can expect to pretty much follow what we've seen in Europe with about a 2-week lag. I mentioned that we're looking at a lot of the mobility data. I think that the data from Apple is really cool because it comes out every day, and we see that more and more people are driving around. There are not as many people that are solely staying at home. They're getting out. They're going to the stores. They're going out and buying the things that they need. And we've also seen a lot more people walking, which has been a big return there. We're almost back to where we were when the shutdowns began in terms of those two activities. Where we haven't seen any measurable improvement has been in people using mass transit. It has come off its lows, but it is well off of where it was previously. Now some systems are shut down, which makes that impossible to come back, or they're running on reduced schedules. And the weakness in transit use is one of the reasons that driving is probably picked up as well. Another source of data that we're following is the data from Open Table. You can see how everybody shut down pretty quickly. And Open Table is, they publish data on reservations for seated dining, and many restaurants closed to everything except takeout and drive-through. Overall, that was about a 75% pullback in business. I thought it was 85 was the numbers that I was using, but evidently it was about a 75% drop in business. And we have seen that some states are beginning to see a little bit of a rebound in seated diner. Florida's one that really stands out, as does Tennessee. Georgia, as I mentioned, even though they were an early one to open up, just because you can reopen doesn't mean that you will reopen. And then you look at California down at the bottom there, in New Jersey, and the recovery in seated restaurant dining has been very, very modest because, as I said, California's, the conditions are Los Angeles and San Francisco, and it's really Los Angeles more than San Francisco, is kind of setting the tone for the state. The TSA numbers show a similar trend where they're looking a little bit better. They're down 90% instead of being down 95%. They're still down an awful lot, and airports are not all that busy. One of the other real-time indicators to watch is initial unemployment claims that come out each Thursday. You saw a big spike in them. 38 million initial claims have been filed. I think that in terms of overall job losses, we're not going to see 38 million jobs lost. I don't know how many fraudulent claims are in here, but I would think that they're in the millions. There are a couple of states that have some specific issues with it. It seems to be some foreign nationals that are involved. But the job losses are still going to be enormous. Maybe they're not 38 million, maybe they're 33 million. But the important thing is looking at the trend, and the trend is coming down. My understanding is that the federal government is onto the fraud fairly closely. In the month of April, we lost 20 million jobs. You can see this abrupt, it wiped out almost the entire 10-year recovery in employment that we saw. In May, the employment numbers measure from mid-month to mid-month. And when we get the May numbers, I think we will probably see another 10 million jobs lost. So, that'll be job losses totaling about 32 million, March, April, and May. When we get the June numbers, I expect to see an increase in non-farm employment. If you look at which industry has lost the most jobs, it's leisure and hospitality, other services, which include car repair shops, nail salons, massage parlors, whatever. And then trade, transportation, and utilities. Retail trade has lost a lot of jobs. Transportation has actually gained some jobs. Job losses in construction and manufacturing look about like they would in a normal recession. Unemployment rate's currently at 14.7%. The Labor Department says that it's really 5 percentage points higher than that some people mischaracterized their employment situation. I don't know what to make of that. I do think that the unemployment rate's going to get up to 25% for a brief period of time. If Congress, if the House and the Senate agree and they extend the federal unemployment benefit without any changes, it will take longer for the unemployment rate to come back down. If they do not extend it or they make some changes that increase the incentive for laid off workers to go back to work, then the unemployment rate will come down by half by the end of the year. So if we top out at 25%, we'll have an unemployment rate of 11 to 12% if the unemployment benefits are not extended or are extended in a way that encourages folks to reengage in the workforce. I can't really tell how that's going to play out. I think that politically it's going to be very hard not to extend unemployment benefits. And in a state like California, it makes a lot of sense because it's a high-cost place to live, relatively high wages. But for most of the country, given that so many of the workers that have lost jobs are in leisure and hospitality and retail trade, the federal benefit plus the state benefit is more money than folks would get by working. And if you work at a restaurant and part of your compensation is based on the volume of business because you get a lot of tip revenue, that's probably not worth your while to go back to work if you're going to give up something either more than or close to what you would earn in income. So right now, we think the unemployment rate will come down. 78% of job losses are temporary. That's at least as classified by the Labor Department. Not surprising that small business confidence has come down. It's come down pretty hard. I mentioned the GDP, our GDP forecast. This is just a chart that shows it to you. Big decline in the first quarter, huge decline in the second quarter, nice rebound in the third quarter and the fourth quarter, and then we get back to closer to our trend growth rate of around 2.3% thereafter. Biggest drops in retail sales that we've seen since we've been calculating the numbers. Also, largest drop in industrial production we've ever seen. That drop was largely concentrated in big assembly plants like automobile assembly plants, appliance assembly plants, aircraft assembly plants, which all shut down pretty much. One of the things that is somewhat encouraging about this recession, the recession environment that we're in, is that we don't have a lot of the typical imbalances that exist when you go into recession. We didn't overbuild commercial real estate. Residential real estate also didn't get overbuilt. Vacancy rates for all property types are relatively low. There has been a lot of apartment development, a lot of high-end apartment development. As far as we can tell, over 90% of apartment renters in those communities have paid their rent on time. The problem is more in the older apartments, what's known as the B and C or workforce housing. Those apartments tend to rent to a lot of folks that work in leisure and hospitality and retailing, and those industries have struggled a little bit. All that said, there's a lot of apartments under construction in the country right now. We do expect the vacancy rate to rise because employment growth is going to be relatively modest. I like to tell people that recessions tend to accelerate trends that were already in place. And one of those trends I alluded to at the start was that we were seeing the return of the affordability migration, that rather than moving from the coast of California to the Central Valley, we were seeing more and more people were getting up and moving to Texas or Arizona or Nevada. That out-migration was accelerated by the changes to the federal tax law, which limited the deductibility of mortgage interest and property taxes. I think there's some hope out there that's going to be addressed by Congress. I'm not so sure, because we're going to have a budget deficit this year. I'd say it's going to be between $3.5 and $4 trillion. Next year's deficit is going to be at least $2.5 trillion, maybe $3 trillion. I think we're looking at higher taxes, and I don't think it's going to be possible to provide that kind of tax relief and raise taxes elsewhere, because that would mean that the tax hikes would have to be even greater. So I'm not so sure that's going to happen. But this chart gives you an idea of where people are moving. Texas has 4 of the 8 fastest growing metro areas in the country in terms of net domestic migration. I've got some of the similar data for San Diego just included in here. The mobility data looks pretty good there, particularly walking. Walking is back above where it was prior to the recession. Driving is basically up in line with the state of California. Looking at the open table data for the state of California, we put it up there against Florida as kind of a benchmark, and you can see San Diego and Los Angeles are about even with each other, even though LA got started a little bit earlier. Looking at jobless claims in California, 4.5 million claims have been filed in California over the past 9 weeks. Numbers have been trending down, although the latest number was up a little bit. Looking at payrolls, California lost 2.3 million jobs in the month of April. About 900,000 of those jobs were in the leisure and hospitality sector. Looking at job growth across the state, this didn't come out as great as I wanted it to be, because you can use a little bit more on the x-axis, but you can see how all areas of California saw really large job losses. Southern California saw the greatest. It's also the largest. Unemployment rate in California is up to 15.5%. We actually are going to have a rarity. I mean, it's always something rare. We had the lowest unemployment rate in California's history this year, and we also have the highest unemployment rate in California's history this year. Really quite remarkable. I mean, one of the things that so many people tell me is, I can't believe this is only 1 year. I can't believe it's still 2020. It just seems like there's been so much that's gone on this year. It's really quite remarkable that we've gone from the lowest rate we've ever had in the state to the highest rate we've ever had, virtually in the blink of an eye. San Diego's payrolls fell by 13%. One of the things that we saw coming out of the last recession was that the metro areas came out of the recession much faster than the coastal metro areas came out much faster than the inland areas. I think that the coastal areas probably got hit harder by the COVID shutdowns than the inland areas, because they have so many more jobs in the leisure and hospitality industry than the inland areas do. Got a little breakout on job losses by industry. Leisure and hospitality really stands up. And then we've got our forecast going forward. And this forecast was made about 2 weeks ago. We get the data every day. We get new bits and pieces of economic data. What we've gotten so far would suggest that 4.8% decline in the first quarter, which is the last reported number that we get an update on that later this week, is probably not going to be as bad as it looked. It's probably going to be down 4 to 4.5%. But the 24.7% decline that we're projecting for the second quarter is likely to be significantly worse. One of the big swing factors was the healthcare industry. In the healthcare industry, we saw that doctors, dentist offices, therapist offices all shut down completely. Most of that shutdown was confined to April, where it fell in the second quarter as opposed to the first. And judging by the spending data, which probably lags a little bit, but that's the way that BEA puts it together, it's going to take that decline in the first quarter and push it into the second, and you annualize it. And so it's one other reason why we think the number is probably going to be -30 as opposed to -25. We do see long-term interest rates rising a little bit from where they are right now. Not likely to have a whole lot of an impact on mortgage rates. Long-term interest rates, there's always a flight to safety, and we saw a bit of that. And so a lot of folks wanted to buy treasuries, and they reached for yields. They went further out and bought longer-term bonds. That's beginning to unwind a little bit. The stock market coming back, there seems to be a little bit more of a risk-on move, and so we're seeing that the yield curve steepening a little bit. but interest rates are going to remain low for a very long time. Last point I'll leave you here with is inflation. Most recently, the inflation numbers have been negative. Gasoline prices have plummeted. We've seen that the price of about everything other than food has come down. I don't think we're going to have a huge inflation problem coming out of this, but the global trading system is impaired, and globalization has been dealt a little bit of a setback. The supply chain for virtually anything that's made anywhere in the world is disrupted. We are seeing a supply shock. On top of that, we've had the most explosive money growth that I've seen going at least back to the 1970s. Now, I don't think we're going to have a huge inflation problem, but over the last 10 years, inflation has consistently run about a half a percentage point below the Fed's target. I think from the period 2023 to 2033, that inflation will consistently run a half a percentage point or maybe a little bit more above the Fed's target. What that means to me is that, if you're in a position to take advantage of these very low interest rates and lock them in for some time, it would be a really good idea, because when we come back out of this, when we do get a vaccine and we move past COVID and the recovery and we get back to where we were previously in terms of economic activity, I don't think the Fed is going to wait nearly as long as they did following the financial crisis to begin to normalize rates. And I think they will move much more quickly than they did in that environment. So just a little advice there in the way of interest rates. I'm going to stop there and I'll hand it back to Eric.
Well, Mark, thank you so much for that. Again, you'll see at the bottom of your screen questions and answers. So feel free to type those in. We've been monitoring them. One that came up, and I just want to make sure for those of you that have been to prior breakfasts, and that's a great lead into our next speaker. We did produce the indicators report this year. We produced it as a PDF. All registrants will be sent the link to that. It'll be hosted in a couple of different places. And we're really looking forward to, again, continuing our indicators project that we brought to you every year. Again, questions and answers for Mark or for any of our presenters or panelists. So with that transition, I want to introduce Josh Williams. Josh Williams is the president and founder of BW Research. And he has been leading that organization for almost 20 years. His work tackles the tough questions around the changing nature of work, the innovation of industry clusters, and the evolution of regions as they look to expand economic opportunity and the higher quality of life. Josh has been our partner in producing the North County Indicators Project. Also at BW Research, they undertake a major national study of the green and solar industries to help inform that changing transition to a post-carbon economy. Josh has a bachelor's from GW, where his son will be attending in the fall, or probably attending in the fall with COVID. I know he's really proud of that, and a master's degree in economics from Cal State University, Long Beach. Josh is going to go through, and I won't steal too much of his thunder, but the North County indicators briefly, and then lay out for us a agenda for his views about how we can recover from COVID-19 more quickly in North County. And again, as we said, if you go to the North County Summit website that you all registered on, or the San Diego North EDC website later today, we've got sign-up sheets for anybody who's interested in participating in some working groups on the subjects that Josh is going to talk about. With that, I'll turn it over to Josh, and I know he's shared his screen already. So Josh, thank you for joining us today.
Eric, thank you. Everybody out there, I miss you. I enjoy our annual get-together in person. It'll just be that much sweeter when we do it next year. So with that, I want to jump into a lot of data, but I'm going to try to go slowly. So that's the challenge for me today. So I'm going to do that. I want to do three things today. I do want to give you an overview of the North County indicators. I know a lot of you out there have seen this. This is our 7th iteration. It was originally North County Prospects, and Eric came on, I think rightly said, let's change it to what it is, which is a group of indicators. So I want to talk about kind of what it is and why it matters. I do want to give you a little bit of some of the data that we were seeing before the COVID hit in kind of March of this year, and what we learned about kind of North County over the last kind of 12 months, and some key trends that I think we need to think about that'll help us kind of in the last part of the discussion, which is really probably the bulk of the presentation today. What's next for North County as we think about how we recover from COVID-19. So with that, I'll jump into it. Let's talk about what the North County indicators, or NCI, is. It's really a quantitative analytic set of indicators. It's grown every year. So we're now up to 47 metrics and 76 data sets that really represents 5 different categories of the economy. People, at the end of the day, the most important part of any economy, the economic interactions, innovation, some of the things related to place, transportation, infrastructure like that, and education. So there's 47 metrics in those areas. When we talk about North County, it's important to remember we're talking about an area that we split into kind of these 4 kind of smaller areas, but we're really talking about kind of the 56 freeway at the south end with Del Mar and kind of Sorrento Valley, just above kind of Sorrento Valley. And then going out east all the way to the eastern border of San Diego County. At the central inland, that includes Poway and Ramona and Julian. And then as you move north, it includes as far east as Borrego Springs, but Palomar, Fallbrook, Escondido, and on the western end of the inland is San Marcos. And then the north coastal goes as far north as Camp Pendleton down to southern Carlsbad, with Encinitas being the top of the central coast. So that's the area. When we're talking about this, we're talking about, this is 1.2 million people. This is, has more jobs than Honolulu, would be the 42nd largest state, both in terms of employment and population. So not an insignificant, area, representing, about 35% of San Diego County's population. Again, we talk about these 5 key components and the report. Again, I'm not going to spend a lot of time talking about each one, but I will say the report this year, we spent a lot of time on it. I would recommend all of you to kind of look at that. I'm not really going to summarize the indicators today and the feedback. I'm going to really focus on some of the highlights, some of the things that I think that matter, but I do think there's some value in reviewing and reading that. I would also say that the indicators really reflect pre-COVID. The data really reflects all of 2019, and so the data stops really in January of 2020. It kind of goes through 2019. So and some of the data sets are even older than that, but most of it we strive to go through 2019. So be aware of that when you look at kind of the data. I mean, one of the things we'll talk about today is tourism, hospitality, and recreation, and Mark already talked about that a little bit. But yeah, I mean, we think that the 70,000 jobs that were in North County in that industry is probably now currently at about 30,000. They've lost over half their jobs, or North County has lost over half of its tourism and hospitality, going from the largest industry cluster in terms of employment to near the middle. And so there have been some big points. We're also then looking though, so I'm going to do this in 2 parts. I think there's some things that we can learn about North County, kind of, looking at that last, the pre-COVID, through January of 2020, and then we'll focus on really what we can be thinking about as we recover and respond and recover stronger from COVID. So one of the things, I think it's hard to look at the story of North County's economy, over the last 3 to 5 years without really focusing on the growth in some key industry clusters. And there's 6 industry clusters that we have a particularly high concentration in. And these these clusters really have driven the growth and really the growth in the quality of jobs on the area, and a change from what was, 10 years ago, much more of a bedroom community to now more of its own kind of economic region, in connection to, larger economic regions. But the growth in defense, aerospace, transportation, manufacturing, information and communication technologies, biotechnology, and biomedical devices, those three industries particularly really represent kind of the high wage, high growth clusters in North County, with agriculture and food and tourism and hospitality and recreation representing some of the lower wage but higher concentration industries in the region as well. Really, the outcome has been, though, if we look at that over the last 10 or even the last 5 years, growth in tier one jobs. Tier one are your higher paying, higher wage positions, have grown by more than 25% over the last 10 years. And if we look at the last 5 years, they've grown, tier one jobs in North County have grown 40% faster than they have as the nation as a whole. So this first slide kind of shows on the vertical axis kind of the average annual earnings. And on the horizontal axis, you can see employment growth over the last 5 years. And all of these high concentration industries for North County have grown. And some have grown by, relatively, mature levels at, 3, 4, 5%, agriculture and food, biotechnology and biomedical devices. Whereas, defense, aerospace, and transportation manufacturing really, connected to the drone industry has grown by over 150%. In the last 5 years, but all these industries have grown, and particularly the top, the ones at the higher end of the vertical axis, ICT, defense, aerospace, and biotechnology, have really pushed the increase in tier one jobs. So you can see this in this next slide. This is not typical of a lot of regions where tier one jobs are outgrowing tier two, and I mean they're growing three times as fast as your tier three. Remember, tier one is your higher page. In North County, tier one jobs have an average wage of about $90,000 a year. Tier two is about $45,000 to $50,000, and tier three jobs pay about $25,000 to $30,000 a year. So that gives you kind of some idea of the wage differentials that we're referring to. Another important story for North County, kind of before COVID hit, was really the high educational marks that the region got. In both English language arts and math, North County as a whole was, anywhere from 40 to 25% higher in terms of proficiency than California. And, even as we look at some of the areas, North County, Central Coast, and Central Inland were scoring higher than comparable counties really across California, including Orange County and Santa Clara County. The region is also, for the colleges and universities, Cal State San Marcos, Miracosta, Palomar are all, over the last 10 years have increased their annual degree completions in science, technology, and engineering math by by almost 200%, 3 times the comparable rise in California. You can see some of the scores for each of our areas, but even each of the areas within North County are all above the state average for, this is K-12, and this is math proficiency. You can also see it, that same trend in English language arts as well. So the schools are doing well, and on top of that, each of the areas within North County, that's average spending per student is well below the state average as well. One of the interesting things we found in the data this year, last year we had pointed out that one of the challenges that North County was facing was the growing disparity in household incomes that we were seeing. It still is, North County as a whole is still a relatively affluent community if you look at the averages, but those averages really hide some economic distress and some poverty and I hate to use the word poverty because poverty is connected to kind of national norms, and North County is definitely a high cost area. So we'll use the term economic distress. But you can see that really for the first time in the data, we saw either a reversal of a trend or maybe it's a one-year blip, but we started to see growth in household income happening in areas or within North County that have traditionally had the lowest level of median income. So if you look at North County's, and actually North County's Central Inland increased, and we saw a reversal of some of the trends in income that we had seen, over the last 2 or 3 years. It is still important to point out, though, that the region as a whole has a lot of diversity. I mean, if you look at North County's inland area, 25% of households earn less than $35,000 annually, which is, considerably, under self-sufficiency. When we state that, it's the ability to live in a community without really any sort of assistance. That number is typically anywhere, we think annual income to be self-sufficient in North County is about 50, 55,000 based on housing costs and the cost of living in the region. Whereas if you look at, North County's Central Coast, over 40% of households are bringing in more than 150,000 annually. So there is a lot of kind of diversity in terms of, kind of the economic income in the region. You can see one of the areas, though, that the North typically over the last 5 years we've looked at this, or 7 years we've looked at this data, the North Central Coast has been double the North County inland in terms of annual median income. And for the first time, that's not true. The increase in North County's inland was enough to offset that. So it was more than half of what we see in the typical median income in North County Central Coast. So now let's get to the kind of the bulk of the conversation today is really to look at, okay, we know that our region and our economy and quality of life really has been impacted by the coronavirus and the quarantine that came out of this. How do we respond to it? What are some of the things we should think about? And I would say, I don't know if I necessarily have answers, but I have areas where I'd like us to really think about how we push North County or at least have a discussion about how we can build on some of our strengths and help maybe support some of the more vulnerable populations. And I think it really starts with, if you look at the 3 high wage, high concentration clusters in North County, they're biotechnology and biomedical devices, they're information and communication technologies, and they're defense, aerospace, and transportation manufacturing. And all of those are really science-based, innovative industry clusters that are really looking to whether they're developing new materials, using new genomic sequences, or really building on kind of the science platform that have really helped kind of innovate within the region. So the question becomes, how does North County become a hub for solving emerging risk factors? And I think one of the other things that's important for us to think about is, I've been over this quarantine looking at and following a lot of kind of World War II, kind of documentaries. And I think there are some comparisons to kind of World War II and the coronavirus. And I don't want to try to say that, the struggle that, my grandfathers who fought in the war is anything comparable to us, being quarantined home. There's no comparison. But there is a comparison in that this is a pandemic that's come on fast and it really impacted the entire global economy. And the changes that Mark Vitner talked about, have happened really fast. And there is likely to be some big changes. I think one of the differences is the war that we saw in World War II was really won by military might and the defense and military industrial complex. And I think coronavirus is really forcing us to look at new risk factors. And obviously the risk factors related to pandemics, but also, what are the risk factors related to weather and the more volatile weather that we're seeing in terms of, rising sea, and those related to climate change? What are some of the concerns related to potential seismic activity? So how do we deal with some of these risk factors that are different than kind of what we're built at from, based on kind of the 20th century challenges that we faced? So with that, I think looking at how North County as a region is connected to the larger kind of Southern California economy continues to support its innovation industry clusters through regional talent, through research and educational institutions, but also really looking at kind of some of the work that the public sector and its infrastructure to support, whether that's in the electrical grid or in terms of bandwidth, and even supporting kind of investment and innovation or initiatives in some of these, asymmetric risk factors. So I think that's an area that we really want to continue to really, or it's an area we want to explore. I think you heard Mark earlier talk about kind of the significant change. And while, COVID-19 has really shook up the global supply chain, we're also seeing it in terms of, some of the new trade issues, whether it's increased tariffs or threatened trade wars. Supply chains are really going through an area of, of transition. And we've been in such a focus of globalization and specialization, but some of that's likely to change. And, one of the things that may be surprising when you think about North County is a manufacturing, hotspot. It's, 10% of all jobs in North County are in manufacturing. That's twice as many as the rest of San Diego County. So the rest of San Diego County, only about 1 in 20 jobs is in manufacturing. In North County, it's about 1 in 10. In California, about 7% of jobs in manufacturing. 7% of jobs are manufacturing. So North County is a manufacturing, has a manufacturing concentration. But it may not, the problem is when you think about manufacturing, it's not necessarily the big assembly plants. It's not big, car manufacturers. It's in, aerospace products. It's in navigational and, measuring, electromedical and control instrument manufacturing. It's in, telecom and communications equipment, and it's in medical equipment. And so, and a lot of it's not actually assembly work. A lot of it's the design and the development and the research and development that's part of that manufacturing supply chain, really the first part of it. So I think we need to think about what is the role that these North County manufacturers have in that supply chain, and how will this change in the global supply chain impact their supply chains. So I think another area, and I will say, when we started writing the North County indicators in about February of 2020, so kind of a month before the coronavirus really started to hit our community, we were thinking and talking about kind of regional economic resiliency, and this idea of how can North County kind of resist or minimize the economic event of a shock event, like a pandemic, like a weather, cataclysm, or a seismic event, and how does it recover quickly from such events? So really, economic resiliency is both of those, minimizing the impact, but also, and I think probably, more likely, how do we recover quickly from such an event? So, and really, there's the research on economic resilience really looks at a few different things, and one of them is kind of what's your industry cluster or your industry diversification. And if you look at the North County indicators, this is a real strength of North County. North County isn't really built upon and growing on one industry. It's a lot of different industries. We talked about them already, and they're real strength of the North County economy. Another area that the Fed has been doing some work on that came out, about 6 months ago, was this idea of areas recover quickly when households have a relatively low household debt to income ratio. And so what's the household level financial stability? And in North County, this is more of a mix. The overall income of the area is relatively strong, but we know that there's economic distress. We know there's communities within North County that do have considerably higher debt to income ratios. And so this is an area that we're concerned, and particularly given the large portion of employees that work in tourism and hospitality and recreation, which tend to be lower paying, leads us to believe that this is an area where our more vulnerable populations are likely to be impacted sooner and are feeling the impacts of the quarantine and the significant unemployment jumps. Another area that's important, though, in terms of this economic resilience is economic agility and entrepreneurship and innovation, the ability to really create new businesses, create new products, and develop new services in response to these shocks or disruptions. And we're already starting to see some of this in terms of some of the changes, in terms of some of the new online platforms and how we communicate and connect with one another, and how we sell, and provide information. But how is that changing? We think this is an area of North County strength, but this really requires kind of more data and more analysis for a confident assessment. And to be honest, a lot of the data around entrepreneurship and economic agility, even innovation, is largely county and MSA. We don't have a good sense of how North County is kind of a portion of San Diego County responds, but we know that North County is different enough than San Diego County that just using county-wide metrics isn't, probably as accurate as more North County specific data is. And lastly, we think regional infrastructure and preparedness for, whether it's volatile weather events, pandemic, seismic activity, and this is really looking at the infrastructure related to healthcare, and we've already seen some of the impacts of that in terms of, and we seem to have done pretty well, although North County hasn't seen the kind of the push or the the waves of kind of coronavirus that, other regions has, and even kind of more southern San Diego County has, but bandwidth. And this is an area that the education and world is dealing with as kids move to, more of an online platform. The electrical grid, transportation, water, these are all areas where, we need to consider kind of our infrastructural and our regional preparedness for, shocks to the system. Lastly, rebuilding and strengthening the tourism and hospitality ecosystem. We've already talked about this. BW is doing a lot of work on looking at kind of what is the impact to industry clusters. And our latest, we just did a national, and we're looking at a regional impact as well, but our latest national impact, as we think through the month of April, 60% of tourism, hospitality, and recreation jobs have been lost in North County. And that means that the county had about 70,000 jobs before COVID-19, and we think it's, now it's probably at 30,000. And while we do think a lot of these jobs will come back, we don't think it's going to be a V-shaped recovery until a vaccine or some sort of, an immunotherapy that really limits the mortality of the virus to more susceptible populations exist. So we're not going to see a jump back up to 70,000 jobs, in a few months. It's probably, a year or two out. This matters because, a lot of the region's lowest paid workers are in tourism, hospitality, and recreation. So they're the ones, that aren't able to go find a new job right now. I think from a talent and from a skill development, though, this is oftentimes really where a lot of the region's youth develop their first non-technical skills. And as more education has moved online, the development of those non-technical skills, those social skills that allow you to connect and communicate and work in a social environment. I think one of my concerns is, we are in an environment where we're quarantined and we've, social interactions have declined, but they will come back. And I think students, that are, in high school or in college and are learning those skills for the first time, I'm concerned about, an environment that becomes more online and maybe more socially isolated. How do we overcome that? I think the cities recognize they know the impact of the revenue through TOT or transit occupancy taxes and visitor sales taxes. Those are all being impacted. But I think also tourism, hospitality, and recreation plays a valuable role in our region's quality of life. I think the other kind of existential threat that may not be impacting us now, but something we need to be thinking about is the potential rise in sea level, and the impact that could have on beaches in North County. So all these things are things that we need to think about as we look to really strengthen and re-strengthen our tourism and hospitality industry. Lastly, and this is kind of the last of the areas that I think is important, really looking at how we invest and support, education and upskilling in North County. We've really seen that, North County's education is a real strength of our community. We saw not only is it a strength in terms of the performance, but also it's a reason how we're able to kind of bring in talent into the region. People move to areas where they know their kids can get a good education. And I think it's something that we really need to kind of make sure that, given California's current budget and budget expectations, this is an area where as a region, I would say we really need to invest and make sure, whether it's advocating or directly investing in our K-12 system. I think this is an important component. I think we also need to make sure we're facilitating collaboration between schools and districts as they really support the challenges that teachers are facing right now. I think, I just saw they did a survey nationally of teachers and students, and there's a concern that 10 to 20 to 25% of teachers could be retiring because of the challenges and just the differences that you're going to face in an online environment. I do think we need to look at online platforms, but I would also say, learning from what's happening in Denmark and Taiwan and some of these other countries that are already bringing kids back to school, I think is valuable and something that we need to look for and innovate in our region. And lastly, we need to think about how we work with universities, colleges, and K-12 and connect them with industry leaders to better understand how these changing skills needed for the new world of work is happening. I mean, the changes that we've seen in industry cluster employment in the last 4 months is bigger than changes we've seen really over the last 4 or 5 years. And there is going to be changes that will be permanent, and there will be things that we need to help our students and our colleges and educational institutions look for. So, before I finish, so those are really kind of the 5 areas that I think we need to really look at and consider to really help expedite and really bring North County back, kind of stronger and faster from the coronavirus. But I think there's 2 areas that we need to, that are kind of foundational challenges for North County that we need to be thinking about moving forward. And these are things that were problems kind of before coronavirus will happen, and we need to think about them as we look to rebuild our region. North County does have, the economic growth that really has, and the economic opportunity that really I think is a real strength of North County, hasn't come to, trickle down, or hasn't, shown itself in all of our communities. And so we really want to really focus on creating economic opportunity for all the populations in North County. And we can see, if we look at kind of different zip codes, that there, we look at the poverty rate, and many of you heard that I don't love the poverty rate because it's a national index. But if you're living in poverty in North County, which is, a high cost of living area, housing is, considerably higher, but even other goods are higher than the national average, you're really struggling. And there are zip codes where over a third of households and over a third of residents are living in poverty, compared to other areas where that number's 3 and 4%. So there's a lot of kind of differences in terms of economic opportunity and economic outcomes of the North County. That's something to think about. I think the other area, though, that I think is really only going to become more challenging, as we come out of this, is the availability of housing. And how do we really find that? How do we increase the availability of housing to deal with the challenges that we're going to see potentially, where it increase, the need for workforce housing, the challenges associated with homelessness, but even the ability to continue to attract entrepreneurs and talents that we need for the industries that are really going to drive North County's growth. All of those, while we maintain North County's high quality of life. So how do we balance those 2 things? I think those are 2 of the kind of the foundational challenges that we're going to have, that were there before the coronavirus and will be there after, but we should be thinking about as we move forward. So again, I've given you a lot of information. I will say this online is particularly challenging for me because I can't see your smiling faces. So I missed that. Hope that to happen soon. But if before I finish, just real quickly, if you're interested in any of those kind of 5 kind of strategies and considerations for North County's recovery, to get involved, go to that website at the bottom, www.nceconomicsummit.org, and get involved and provide your insights. I think one of the things I love about our North County community is it's a diverse community where there's lots of people who are working and living and seeing things from a different perspective. So I'd like to hear kind of all of those different voices in those strategies. I will say BW Research and our website, we are putting together new kind of data that really shows how our region and California and the country is recovering and responding and being impacted by the coronavirus. So that's a resource for you moving forward. And I would really encourage all of you to take a look at the North County Indicators 2020 version. Eric will have it available to all of you, I think today. So with that, thanks everybody. And if you have any questions, just click on the Q&A and I will be around to answer all of those. Thanks everybody.
Josh, thank you so much. That was fantastic. And again, as Josh said, there's the Q&A button. We've already been starting to get some, so feel free to chime in there. Also, Josh put up that website. I will also, again, put it in chat a couple of times, or in the Q&A section, actually, so that people can see it. And again, in thinking about bringing the North County Summit online, we saw this as a great opportunity to do some things slightly differently, which is to engage the 202 people that I know are participating right now as attendees, and to give you an opportunity to extend this past just a 2-hour seminar. And as Josh identified, we saw in the indicators and in thinking about COVID-19, at least 5 places where there was substantial work which can use your insight, your talent in thinking through what it might mean for North County in sets of public and private and blended policies to help our economy recover faster. Josh did that. And again, you can sign up for one of those working groups, and we'll be in touch if we've got a critical mass and see what we can stand up. We also saw this as an opportunity. So we, with people being able to simply unmute their mics and not have to do the shuffle on stage, we thought it was a great idea to bring on two respondents who could think about what the panelists or our presenters talked about, and give us their take on what they think those presentations mean for North County and for our economic recovery and for businesses in North County. And I'm so excited to introduce our first panelist or respondents, Miguel DeJesus from Cal State San Marcos. I had the pleasure of meeting Miguel, maybe 6 months ago, and he is the relatively new Director of Business Development for the College of Business Administration at Cal State San Marcos. He also serves as a faculty member teaching sales and sales marketing, leadership, international marketing, and sales. And he does so with a background which is fantastic for North County to be able to tap into more than 35 years of experience leading business management and global sales and marketing entities within 2 Fortune 500 companies and a number of other startups and entrepreneurial experience that Miguel brings to the table. He's got a wealth of experience along with a long list of publications that he is the author of. And we're so excited to hear what Miguel thought of our presentations and what he thinks they mean for North County. So with that, Miguel, the floor is yours.
Awesome. Thank you so much, Eric, for the introduction and the kind introduction. So I really appreciate that. So I get the opportunity to share a few concepts, ideas that may have been triggered by both of the presentations, both from Mark and from Josh, in terms of the COVID-19 response that the higher education community, Cal State San Marcos, in specific, is taking to initiate some transformation, both in thinking, in strategies, and more importantly, in executable plans for the business community of North County. It is certainly a diverse community in the North County, ranging from single employee operations to enterprise level companies. And from that perspective, the answers, the solutions, the insights, and the strategies have to be designed very specifically and very precisely for those different markets and different opportunities. So a couple of things that Josh mentioned, as did Mark, that we think is important in terms of transitioning towards a more favorable post-COVID environment, has to do with a couple of issues that were mentioned. And the public and national debate is still unsettled in a couple of these areas. So it requires public policy discussions and decisions. One has to do with the element of childcare. Unless and until someone creates policies, and it's probably going to start at the local municipal areas and the district school levels throughout San Diego County, the issue of childcare has to be addressed. Otherwise, you're not liberating, you're not freeing up the productivity that is available to us in North County. So that is a tremendous imponderable at this point that has to be discussed and strategies developed to bring children back into a classroom to free up their parents to go do the productive work that they would probably like to do. Not that their children aren't important, but there are other things that would liberate and free them up from a productivity standpoint to do that. The second piece of it that's already in motion has been a transference of those skills to the home environment. So there are probably ergonomic studies that will be conducted in the next few months, perhaps 6 months, that will study the effect of home office workers for parents and everything else that we don't know at the moment. So those are the two elements that I thought were significant that need to be answered. The second thing has to do with the workforce age that I have not heard enough people talking about either. The university is certainly concerned about that as well. And how do in the 60+ area, how do you provide safety for those employees, especially those who may have autoimmune deficiencies in the absence of a vaccine? Now, a lot of this could be remedied quicker if in fact the vaccine appeared magically tomorrow, but it won't. Best estimates, maybe early distribution may occur by December 4Q. I suspect that it's probably closer to 1Q 2021 when we will see ample supply and distribution. So those are two elements that I don't think the public discourse has been sufficiently active about that we think is important. The consumer also has to be re-engaged. We know this Friday here in North County, a number of malls have opened. We will see how the consumers respond to that from both a safety standpoint and from a digging into their purses, wallets, etc., and credit cards standpoint, whether demand will be reignited and re-stimulated going into the summer months. Very important to see how the marketplace responds. I think Josh mentioned something that I thought was excellent, and it could have been Mark also in his opening remarks. The CARES Act and the PPP are all intended to stimulate basically consumer demand through consumption. The impact of that has yet to be felt. It's too early in the cycle. There's not enough data points to take a look at the impact of the probably close to $6 trillion that have been infused into the economy. We have yet to see the impact of that, and we hope it will be positive for us all. So let me share with you how the university sees itself and what we have done. Through the leadership of one of our executives, Jill Ling, through our student success program, we have immersed ourselves with the student community to make sure they transition and they get all the support they need, both mentally from a mindset standpoint and where necessary financially. There has been tremendous success engaged with our university through the volunteer efforts of our executives in residence, of which we have close to 35 that participate on a voluntary basis to support not only those students, but also the business community at large in terms of helping them with their business issues. These are all retired executives with Fortune 500 and beyond experience who are capable of being an additional resource to the EDC's SCORE and other organizations that provide knowledge, expertise, and more importantly, subject matter expertise. So I wanted to share that with you because it's an awesome program that the university has initiated. Currently, we have witnessed and we understand that there are needs and opportunities for transformational thinking and leadership. And we provide a great faculty team to teach in both of those subjects to business owners who are looking for leadership training. And certainly in my case, if they're looking for sales management training and leadership, I could certainly help and assist in that area. Entrepreneurship is huge. This is going to spark, on the other side of difficulty, setbacks, transformation, dismay, and disappointment, there is opportunity. And those people who have an entrepreneurial mindset will seize on those. Let me give you an example. Those organizations in the restaurant industry that transform into a delivery service model for dining on the lower end, not fine dining, have probably come out of this thing fairly neutral. Why? Because they transitioned, they pivoted, as I like to say, to the new realities of what's going to take to be successful moving forward. So entrepreneurship is important. Skills development, we cannot highlight that sufficiently. We work through the faculty and our students to make sure that they graduate and develop skills that are transformational and effective almost immediately upon graduation from school. And a statistic that is common to most of our students, a full 70% of our student body are workers. They work. They are employed currently. And so that helps develop skills and bring to the marketplace the skill sets that the business owners need. E-commerce skill development is going to be huge in post-COVID environment. So I'm going to explain what that means. If you are not driving traffic and conversion to your website in whatever business you're in, you're missing an opportunity. The question that business owners have is, let's assume that they buy into that notion that they need to do more on the web, is who do you outsource that to? Who can work on that? And that really fits very nicely into the partnerships that the university has formed through the local chambers of commerce to be of support and assistance in helping them transition to the other side of where they are now to greatness in 4Q and 1Q of 2021. It is really astonishing to me how few of the businesses in North County really seek and work with us at the university to help them through the ideation process and through the strategic and tactical thinking that they need in order to transform quickly and effectively. We at the university run programs that I am responsible for in the course of a year, about 120 projects to help businesses update and really pivot towards the new realities of the marketplace. Supply chains are disrupted throughout the globe, and specifically our businesses here in North County, San Diego. So we're working with fairly large enterprise level companies as well as smaller companies. And when I say small, I mean under 10 employees and a number of solopreneur types of operations to help them develop business plans, marketing plans, financial planning and analysis projections into the future to help them better make decisions that will be more effective to them moving forward. So we are excited to participate in this community, to be of service, to be of support, and to be of assistance. And in that regard, I am delighted to have participated, Eric, with the members that are here, a full 190 at the moment, and hopefully we will be able to be of service moving forward. So those are the comments I would make in relationship to both Josh and Mark. We just completed a San Diego Confidence Index report that shows the kinds of decreases in percentages per industry. Hotel, motel, San Diego industries have been severely impacted. The craft brew industry has been significantly impacted. In fact, some of the owners of the craft brew industry manufacturing capabilities were transformed into other essential requirements like hand lotion, and a few have just transferred their manufacturing lines to different types of products in order to survive this pandemic. So we are living in a time that I think requires leadership, requires a tremendous amount of openness, candidness, and I think and suspect very strongly that the two issues that need to be addressed, one has to do with parents with children, getting the children back to school, and I think that will release a tremendous amount of productivity that theoretically will be necessary to meet the increased demand that comes from the consumer sector. So I thank you, Eric, and all the members for the opportunity to review.
Yep. Miguel, thank you so much for those comments. A couple people in Q&A asked the question about getting contact information for you and the College of Business Administration. We will absolutely send that out to a email to all the registrants summarizing where you can find links and various the presentations and so forth. We did not ask Miguel or our next respondent to prepare slides, so that's why you just saw Miguel's smiling face and picture on the screen. But I know that should Miguel has mentioned anything that sparks your interest or that you'd like more information, that we will get you his contact information so that you can follow up. I just would make a huge plug for the Senior Experience Project at Cal State San Marcos. They stand up really wonderful students to help organizations create value for those entities that engage those students and provide a really wonderful learning opportunity in turn for our Cal State San Marcos seniors. And it's always a great opportunity to kick the tires, and you never know what you might find for somebody who will be entering into the workforce. So Miguel, thank you again. And again, his contact information will be in an email. I now have the pleasure of introducing Ray Major. Ray is the Chief Economist and Chief Data and Analytics Officer at the San Diego Association of Governments. Ray, I've known Ray for too long. I think I'm getting gray hair along with him. And so we've been kicking it around in economic development and regional economic analysis for a number of years. But Ray supports a number of projects at the agency, including the Big Five Moves, its effort to rethink transportation in our region, and I'm sure is grappling with some of even the new changes that we've seen, as well as doing, I think, a great job in terms of a real-time forecast for the region in terms of unemployment and what COVID has meant. And so we ask Ray, as another regional economist, to listen to what Josh and Mark had to say, and we wanted to give Ray about 10 minutes here for anything that sparked his interest. And again, I see a number of questions and answers, and we're going to get to a number of those right after Ray.
Thank you very much, Eric. Thank you for having me. These were absolutely great presentations, and it did spark a lot of interest in my mind. You know, a lot of what we were doing, or what we're doing at SANDAG right now, is really monitoring what is happening through this COVID crisis. But if you would have had us do this analysis or talk 10 weeks ago, I would have told you that the San Diego economy was at the strongest level that it had ever been. We had record low unemployment. Anybody who wanted a job had a job. Businesses were looking for people. There were more help wanted ads out there than there were people who could fill them. And that's where we were 10 weeks ago. And all of a sudden, it's like you crashed the entire economy into a brick wall. You know, this was a man-made shutdown. And the reason I realize that there are health issues related to this, and I don't want to minimize those, but what I do want to say is that the economy was extremely strong before this happened. And had we had a very short shutdown, the original thought was that we would be about 2 weeks shut down, so somewhere from the middle of March through April. I think what we would have ended up seeing is a relatively quick back to normal situation. But this is now dragged out for 10 weeks. And so what's happened is there's been a lot of ramifications to that. And I think Mark pointed out a lot of those. We use very similar data sets. In fact, we use the same data sets in many cases to try to estimate here in San Diego. And just to give you an example, you know, with this shutdown, the taxable retail sales that we were estimating in San Diego, and that's really kind of an indicator of what's happening in terms of economic activity, was down 44% over what an average month would be prior to the COVID lockdown. We lost approximately $2.3 billion in taxable sales. So that's really economic activity that goes in between businesses, and you know, a lot of that results in salaries and income for people to pay their mortgages or to pay rent on their businesses, and a lot of that money is gone. It's not deferred. So when you take a look at the different industries that were hit hard, and this you know, these are San Diego numbers, but North County has a lot of these, and in some cases, even a higher percentage of these businesses. So you were impacted even more. But you take a look at things like apparel stores, and sales there are down by 83%. When you take a look at things like restaurants, they're down by 67%. I mean, 2/3, unbelievable. Service stations are down by 57%. There's no B2B activity, just businesses buying and selling from each other, whether it's Staples selling, reams of paper or whatever it is to other businesses, is down by 50%. And then you have auto repairs and sales down by half. So all of these industries have been significantly hit. Some of these will never regain the money that they lost. Like, for instance, the restaurant industry. And as Miguel said, some of the fast food restaurants, the lower end restaurants, have responded relatively well. But all of those dollars you would have spent on fine dining over the last 2 months, you're not going to go out twice as often. You're probably not going to go out, even as frequently as you did in the past in the coming months. So restaurants are not going to be able to come back the way that they did. The industries that are really impacted here in San Diego are the ones that Mark pointed out. There are things like tourism. Really, tourism, restaurants, and retail are the ones that got hit the hardest in San Diego. But the tourism industry, I'd like to just talk a little bit about, because one of the 3 big drivers in San Diego is tourism. And I know that Josh spent a significant amount of time talking about high tech and biotech, and that is definitely one of the other 3, along with military. So North County luckily has a high percentage of businesses that are in that high-tech field, and they will fare well. There's not going to be a problem there. But along the 78 corridor, you have a lot of restaurants and retail. And when we take a look at unemployment numbers, we've seen that there are significant decreases in that area, and what that has led to is a lot of unemployment in terms of local people who might work at Target or some of the restaurants around there losing their jobs. But the tourism industry is the one that's going to suffer the most in San Diego. And the reason is that until there is a vaccine, which is something that Miguel mentioned, people are not going to feel safe to travel the way that they did in the past. And I'm not even sure that airlines would be allowed, with the social distancing rules, to take full loads of passengers. So not really sure how we're going to get the people here to San Diego to drop the $10 billion a year that they used to, which was really just money that was pumped into our economic structure, just based upon the fact that we were a net importer of people who were coming here either for business purposes like conventions or to recreate. And so any business right now that is related to tourism, so think about in North County, you have Legoland, where normally there's around 3,000 people employed. I think last month they had about 85 people employed there. Those jobs are going to come back, but it's going to take a really long time for them to come back, because they won't be able to bring them back until they can fully open up without social distancing restrictions. Restaurants in the area are not going to be able to open up at more than 50% capacity, and most of the cost structures right now would not allow restaurants to be profitable if they were only working at 50% capacity. So how long this 50% rule goes on is going to be significant for what happens along the corridor along 78. But the tourism industry will probably take 1.5 to 2 years to recover here in San Diego. And with that, any of the businesses that support the tourism industry, so those hotels and motels that support tourists, the restaurants and the businesses that are along the beaches, for instance, that are usually tourist dollars that are spent there, those are going to be the hardest hit, and it's going to take a significant amount of time to recover. I think what this ends up leading to, and these will be my final remarks, is that there will be a structural change within the San Diego economy coming up here. It's hard to predict which businesses will do do better, but the impact on tourism will be long lasting. And because we were so dependent upon it, we are definitely going to be in a situation where that's the long pole in terms of getting back to 100% economy or and minimum unemployment. I would expect that we'd see double-digit unemployment rates probably well into 2021. And as Mark said too, this is not going to be a V recovery. At SANDAG, we were calling it a long V, which basically puts our recovery well into 2022, or kind of the last half of 2022, which I think also aligns with what Mark was saying. So it's going to be a tough slog. We need to help each other get through this. Organizations like the North County EDC are absolutely critical to helping individual businesses get back to where they need to be. When we took a look at the East County data, about a third of the businesses or restaurants will not be reopening because they do not have the funds to pay their back rent and utilities, et cetera. I imagine that you're facing things like that in the North County also. And with the help of organizations like the EDC, that should help really get us through this type of a storm. So with that, I'm going to hand it back over to Eric. And thank you very much for letting me comment on your seminars.
Perfect. Ray, thank you so much. So the first one, and I wanted maybe to throw this first to Mark and ask at the national level for Wells forecasting that then moves into your analysis. How are you thinking about consumer confidence? So, this is the question about what do you think consumers are going to respond in the short term? Will they take their money that they got through the various programs and spend it, or are you going to see savings rates shoot up? And then I think then also, how have you been thinking about forecasting consumer confidence when it comes to the fall and a potential uptick again in cases? And I guess I'll ask one kind of question that's been on my mind related to that. Do you think that some of this has been a New York City effect, that it made a difference that we saw the worst of the outbreak in America's major media market? And so we saw really the challenges of an overwhelmed healthcare system front and center as we looked at that. So Mark, and then anybody else wants to talk about confidence, where does consumer confidence fit into your model?
Well, I'm going to take the last point first, because in the last last trip that I made before we shut down travel, I was in Tampa. And at that time, we were beginning to see the volatility in the financial markets. It was late February. And I mentioned that same issue. I said the fact that New York has this cluster, and that initial cluster they had was tied to the clothing industry. And sort of came back to LA to that too, because there was a huge fashion show in Milan. A lot of the clothes were made in China, so you had a large Chinese presence. And that kind of spurred the outbreak, and that was the initial link back to New York. And of course, all those folks flew back to New York on planes and dispersed it everywhere else. And I said, at that time, I said, the fact that this is in New York and people in New York, including a good part of the media that are headquartered there, and I feel like the world ends, at the end of Manhattan. It is. And so I was hopeful at that time that it would be, that was the case, and that it would be contained in New York. We weren't so lucky. But 40% of the cases, and a good bit more than that, more than half the cases, if you throw in Michigan and Louisiana, one being a large state, one being a small, but both were impacted severely. So we're in New York, New Jersey, Connecticut, and Massachusetts. So 4 states accounted for 40%, 6 states accounted for over 50%. And I feel like sort of how in California, Los Angeles, and San Francisco are the severity and the complexity of dealing with COVID in those 2 large metro areas is dictating the policy for the entire state, where things could be looser elsewhere. One of the things that I wish that I could change, if I was in charge of changing things, it would be to get rid of this whole nonsense about of essential and non-essential. It should be just very straightforward, permitted and prohibited. It should be that simple. Some activities are permitted because social distancing comes naturally. They can be performed in a controlled environment, in a safe environment, and others can't. If we were to have adopted a standard like that, I don't think the shutdowns would have been as severe as they had been. In terms of consumer confidence, this one's a difficult one because consumer confidence, by a number of measures, I mean, the most commonly looked to measures are the Conference Board survey. The Conference Board survey tends to be influenced most heavily by the labor market because they ask 60% of the questions ask questions that are related to the job market. And we lost 20 million jobs. You would expect this thing to be as low as it was or lower than it was in the financial crisis. It's not so low. And we just got the latest number yesterday. And it's holding up relatively well. The University of Michigan survey, the Bloomberg survey, the Gallup survey, some of the state surveys, they all show the consumer holding up relatively well. Another thing that's a bit of a mystery to me, mortgage applications for the purchase of a home have risen in each of the last 9 weeks. They're now higher today, considerably higher today than they were a year ago. We had that blowout number on new home sales yesterday. We were expecting a better than consensus number, but weren't expecting an actual increase in new home sales during April. And the only reason why it wasn't a bigger blowout was because of California, because California actually had harsher shutdowns. So the West was the only region that was down year to year. So, putting that all together, it makes me a little more hopeful. I really think that the leisure and hospitality sector and retail trade bore the disproportionate brunt of the shutdowns. Unfortunately, not every restaurant's going to open up. We were already seeing a shift toward fast casual, away from full service dining. And that shift was most apparent in high cost labor markets like California. The other thing is the shift toward online retailing, and that's accelerated. My mother's in her 80s. She never bought groceries online. That's the only way she buys them right now. So she's got the hang of it now. She called me the first 3 times. She's got the hang of it now. So I think she's hooked on that.
Does anybody else want to chime in on consumer confidence? Otherwise, Ray, I'm going to ask you kind of a follow-up question, and we're economists, right? So we can be kind of ghoulish and not necessarily we kind of like those awkward people in parties that people don't want to talk to because we say we say truth. Maybe I'll speak for myself, right?
No, that's why the social distancing is great. Now all the happy hours are online.
So Ray, on the point that Mark brought up, I mean, is one of the things that how does your analysis, or what is the agency's thinking right now to the fact that job losses were so concentrated in industries where disposable income is actually also low and challenging, right? And the areas where we've seen less job loss, and where people have been able to work from home or remote commute are actually those places which drive demand for tourism, restaurants, durable goods sales. And how have you tried to think about that when we compare this recession to prior recessions where we really saw erosions in household balance sheets that brought all consumers or most consumers back and in a retracting mode?
Well, this recession or contraction, whatever you want to call it, is completely different than anything we've ever seen before. Usually there's some type of external economic shock, like for instance, something with the banking industry or housing industry that will set off kind of a chain reaction in the economy. And as I kind of started my comments, there was nothing wrong with our economy when we decided that we were going to stop functioning as an economy. So I think what we end up seeing coming out of this is that people are going to want to get back to normal as quickly as possible. And I think that you saw a lot of that just over the Memorial Day weekend. If you took a look at what was happening, especially in the South at the beaches, et cetera, people don't like this lockdown. And as much as we can forecast or believe that the social distancing and all of that is going to keep people from living what was their lives before, I have a feeling that consumers, especially those that continue to be employed, are going to start to patronize these businesses as soon as they open. Okay, even if unless there's another spike in COVID cases, okay, which would change what I'm saying here, I think that people are ready to get back to normal. That's why when you take a look at those stores that remained open, for instance, you take a look at the sales at Home Depot and Lowe's, and you take a look at Target and Costco's, the big box, the ones that are open, what you end up seeing is that their spending there is actually increased through this COVID. People want to feel normal. People are going to Target to buy a blender because they want to feel normal. They can't buy clothes right now at a boutique, but they're buying it, online, for instance. So I think you're going to see the consumer spending come back, which is going to help get the economy running again. But really, I think where the problem is going to be, at least for San Diego, is the fact that the underlying structure, where we relied so heavily on people coming to San Diego and dropping their money here during the tourist season and during things like the convention season, that is going to that was significantly impacted probably for the next year, and that's why my comments were that's where we're going to see the biggest problem. But in terms of the low-income people, you're looking at the people who are hit the hardest in this are the communities of concern. It's the Hispanic communities. It's the people who have the lowest levels of education. For instance, they're the ones that work hourly in retail, restaurants, and in the hotel motel industry. That's where the biggest concern is right now in terms of getting those people back to work. And then I think the rest of the economy kind of figures out how to respond to this.
Yeah, I think I'd like to add just briefly on that. I mean, we looked at, kind of that tier 1, tier 2, tier 3 job losses from COVID. And we estimated that 77 to 78% of all job losses were in tier 3. This makes sense because retail and tourism, these are typically lower paying jobs. And they are, while I do agree with Ray, there is a lot of people that want to come back and spend. I think the reality is there's also some changed behavior, and retail will not, I don't think, employ as many people, in those kind of lower skilled tier 3 jobs, even a year or two from now. And tourism will come back, but it won't come back to where it was. It won't be a V-shaped recovery for tourism and hospitality. I think, so I'm worried about those, our most vulnerable populations, and not only in terms of vulnerable populations, but a lot of our young people who are learning those non-technical jobs. What are they going to do? How are they going to develop some of those skills that they need from their first job while they're going to college, while they're, working for the first time outside of high school? So those are the things that I think, we need to be thinking about. And North County and San Diego County both have a high percentage of jobs in those areas.
Perfect. Miguel, let me ask you kind of to riff off of that point. We had some people who asked sort of similar questions about that. As somebody who helps companies think about pivoting and innovating and really rethinking how they develop their top line revenue, what advice would you give to business owners who are trying to make sense of and predict what the short and midterm future are going to look like when, I think, we're still all trying to make sense of a barrage of news and the uncertainty about how the virus will play out. What advice do you give to business owners that are really trying to navigate when the future is cloudy and uncertain like that, but definitely need to be thinking about how to pivot and innovate?
Great question, Eric. So, among the things that we try to do and the faculty and the various faculty advisors attempt to do with a prospective client is basically start in neutral. Try to approach them with an open mind. First of all, they've got to join us. Do you have an open mind? Are you ready to pivot? And if not, then we got to work on mindset before we get to the tactical and strategic elements of what you need to do to shift. Among the things that we have identified thus far in terms of actionable things that every business owner should be focused on, this includes, by the way, nonprofits. and that is top line, generating revenue. How do you generate in the post-COVID environment revenue, top line? So we start with things like how attractive, how appealing, how 2020 or 2021 is your current website. How do you generate traffic? What business are you in? Let's redefine the business that you are in going forward, not the one that you've been in. And again, we assist with helping people pivot. So let me give you an example that became a very evident need for us in the business community and nonprofit community. And that is that they don't know how to generate through an e-commerce model, generate traffic and conversions to their websites. They've never had to do it before. If they were a hybrid model of both online e-commerce and physical, they today are thinking about how much more revenue can I drive online, and potentially, instead of being a regional service provider, becoming a national or a global service provider. That's what I mean by disrupting prior thinking. You've got to step beyond the local mentality and say, how can I be global with a very limited budget? All right, you got to put those two together. But how can I go global? Today's technology, quite frankly, allows you to do that. The gap is that the people don't know how to do it. And there aren't enough service providers, we think, out there in the marketplace to be of service next week. So we're trying to fill that gap through training, education, et cetera, and helping the community. Does that help, Eric?
Absolutely, Miguel. Great answer. I'd like to pivot just slightly. We've got about 5 minutes left, so I think maybe time for 2 questions, and I'd like you to think about that. Josh, let's start with you. So as you sort of thought about North County, our competitive strengths that we've traditionally had as a place with high quality K-12 education, a suburban lifestyle, and how that's been able to attract, how are you thinking about the world of work when the kids are home and when K-12 doesn't exist in its current form? And as you've thought about your crystal ball, what are your concerns about the fall? And you mentioned a little bit, where would you identify 2 or 3 things where there's opportunities for greater collaboration and greater economies of scale in that space that might be put on the table for discussion among our K-12 or even our K-16 leaders?
Yeah, I think this is an area that's probably we need to think about, because I think Miguel pointed out rightly that just the childcare element alone is important. And I think getting people, getting parents being able to get back to work is important. But I'm concerned about 3 things. I'm concerned, one, that we're focusing almost too much on the online model, and the online model is challenging for lots of different student populations. So I'd like to see us kind of learn from the Denmarks and the Taiwans of the world that have brought kids back to school relatively quickly and done it creatively and with, in ways of dealing with that. So I think, I'm hopeful that North County will innovate on that and not just try to say, hey, we're gonna move to an online world, because I think that's not as effective for the students. But I will also say that our schools are, if you look at, we did, City of Carlsbad has done a fair bit of surveys with their business community. And one of the things that attracts, entrepreneurs and talent, they say it's about where they live. It's about the schools in the area. We can't overstate the importance of that. So I think, North County needs to really recognize that if we're going to attract the talent, if we're going to attract the entrepreneurs that are going to build the businesses, we need to make sure that our schools are done, and really focused on serving the students. And I am worried about, too, the burden on teachers. I think that's something that can't be overstated. Their world has been shooken up so much in a short period of time. And the more resources and support that we can do and the collaboration we can do to help teachers, I think is really important, because they're struggling. And I'm seeing the data that says, or I shouldn't say data, the survey responses that say a lot of teachers are just, they're ready to quit. They're ready to retire and end that. And I'm worried about the brain drain that's going to happen. And I know we have high unemployment, but a teacher pipeline isn't short. We can't take somebody and stick them in a classroom and expect them to be effective without the kind of the training and the support and the nuance of that. So I think, as a region, this is an area where everybody's struggling, but I think we need to make sure that we're supporting this pipeline, because it's an important part, not of only of our, these industry clusters, but also just in terms of attracting the talent, the entrepreneurs that we need.
That's great. Anybody else want to chime in on K-12, K-16? I mean, I think one question that, we've all got to lean into in North County is this question that, our competitive strength in K-12 often has been, of course, great teachers, great schools, great leadership, but the extracurriculars and the amenities that we can offer, both because of the affluence of the districts, but also because of the critical mass of the kinds of students and kids that we have in there. Obviously, you're not being able to realize those in a online learning. And it isn't clear necessarily that great schools that have a fantastic drama program or a world-class arts program that really offer those enrichments for the students directly translate to great online learning in those spaces. And how, if we're faced with this situation for a period of time, how we transition this. Last question, because we promised everybody to end at noon. So I want to have the two economists. I want Mark and Ray to think about this. And we talked a little bit about this, but we had a couple questions about real estate and the impact of real estate. How do you see second order effects? So, and how have you tried to think about those? We've said, repeatedly on this webinar, we're seeing the initial impacts in retail and tourism. How are you thinking about, as the economy and demand sort of continues to percolate, what's your forecast thinking about these second order issues?
Well,
Mark,
I mean, there's a number of them, and I think retail and office are probably the markets that have the biggest second order effects. And retailing is pretty straightforward. We're going to see that a lot of major department stores are going to close most of their stores. Some are going to cease operations. Even Nordstrom, which is one of the healthiest ones, closing a number of stores. So I think a number of malls are going to shut down. Those are enormous redevelopment opportunities. I think they will be redeveloped mainly into lifestyle centers with a mix of housing, office, entertainment. That seems pretty straightforward. The office environment is a different one. It's kind of hard to figure out what's going to happen. COVID should be a temporary phenomena, but I'm afraid that we're going to be more like Asia, and that we're going to see some sort of virus that's going to impact us every 3 to 5 years. Maybe not as bad as this one, but just as we had SARS and bird flu and a number of other viruses in Asia. And it brings into question, do you really want to have everybody, you really want to have all your key personnel working out of an office building? And there's a lot of advantages to working in an office, but I think that we're probably going to see some sort of a mix at least for the intermediate term, where certainly in the very near term, folks that are at risk because they're older or they have some sort of morbidity that makes them more inclined to be infected, they're going to be encouraged to work from home, as are people who don't have adequate childcare. So I think that's going to stress the office market a little bit. But fortunately, we didn't build too much office space, so I think we can deal with it fairly well.
Ray, anything to add about the second order effects that you're thinking about at the agency?
Yeah, I think that when you, Mark is right. I think the biggest impacts are on the commercial side. I think that you're going to see a lot of storefront restaurants, especially change ownership. So you're going to see some vacancies there for a while. In terms of the office space, I think that what this whole COVID thing did was it allowed people, it proved the fact that you can work remotely for a lot of the positions. I mean, this is the thing that most companies didn't have time to say, okay, we're going to try to create a remote workforce. So now all of a sudden you're in a situation where you can potentially reduce the number of square feet that you need to lease, which would help with the bottom line. But you can also start to recruit the best people for the job who potentially don't live within driving distance of your office. And I think that's going to be really one of the longer lasting effects. And that is that if I need to hire, for instance, a data analyst and that person lives in Atlanta, it's not going to matter to me that they live in Atlanta if I can effectively, through technology, be able to connect them to what's going on within my organization. And I think what you see there is that's really where you're going to see the changing face in terms of business. You're going to see hiring change. You're not going to have to move people across country to take a job anymore. So I see that happening. In terms of the residential market, San Diego has had, we've had a housing shortage now for the last decade. And so any housing that we build, especially with the mortgage interest rates being as low as they are, I think will be purchased by the people who still have money. I don't see a whole lot of impact there in the long term. With that, I'll hand it back to you, Eric, because I know it's getting to the top of the hour.
Well, first of all, I thank you so much. So just kind of one last housekeeping. We still have over 130 people on the call and thank you for hanging with us for 2 hours. Again, I want to apologize right off the bat. We had a little bit of a technical difficulties because of Zoom to start with. I think they are learning the technology as well as we are. So let me tell you that we are going to be putting up a recording of this webinar so that if you missed anything at the beginning or there were things that you wanted to review, which we're sort of gone through fast, it'll be available. It'll be available both at the northcountyeconomicsummit.org website that you registered on, as well as on our website, www.sdnedc. A little bit later today, we'll also be sending out a summary email to all the registrants so that you can find all the relevant links to documents, presentations, and recordings. I want to thank our presenters. I really want to thank Wells Fargo, who has sponsored this event for the last 8 years, and they have been instrumental. 7, 8, the time flies. So they have been instrumental in making this work, and they were extremely gracious to say, could we bring it online and make it work well? And they have provided Mark, and when Mark wasn't able to be here, they sent their backup pitcher in, and he has been fantastic to provide that national national view and national forecast. Josh, as always, I want to thank you and the team at BW Research for putting together the indicators report. That is an important benchmark for how we're doing as a region. Miguel and Ray, thank you for participating this year as panelists. Your insights were fantastic. I know we'll have you back if your time allows, because I think this has been excellent to get the juices flowing with creative questions and creative insights. John and the team at All Maven, thank you for standing this up. You've been a fantastic group to work with. And again, all the attendees, thank you for participating and being here. Sign up for working groups. We'd really like your insight and your visions as we try and lean into those 5 things that Josh said so we can get our economy back moving again and get North County up off the mat and doing what it does great. Thank you again, and see you later.